studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
After reviewing the general ledger, the next stage is examining the owner's expense report in detail. This is where the accountant begins verifying whether each expense is genuinely deductible or whether it should be questioned or reclassified. An expense report is simply a summary of costs that the owner or employees claim were incurred for business purposes. However, the presence of an expense on this report does not automatically make it deductible. Every claim must be supported by evidence and satisfy the requirements of the Income Tax Act. The review process begins by gathering all supporting documentation. This includes receipts, invoices, credit card statements, bank statements, contracts, and any other records that explain why the expense was incurred. Without adequate documentation, it becomes very difficult to support a deduction if the Canada Revenue Agency requests proof during an audit. Next, each expense is reviewed individually, rather than approving everything at once. Experienced accountants examine every transaction separately. The first question is whether there is a genuine business purpose. If the expense was incurred to earn business income, it may qualify for deduction. If the expense primarily benefits the owner personally, it may need to be removed from the business records. During the review, every expense generally falls into one of three categories. Some expenses can be accepted immediately because they have proper documentation, a clear business purpose, and meet the tax rules. Other expenses require additional information, perhaps because receipts are missing or the description is unclear. Finally, some expenses must be reclassified because they are personal in nature and cannot be deducted by the corporation. As you work through the expense report, pay attention to several important factors. Confirm that a valid receipt or invoice is available. Verify that the expense relates directly to business activities. Ensure that the amount claimed is reasonable under the circumstances. Check that the transaction has been recorded under the correct accounting category. Make sure the supporting documentation is complete and legible. Finally, ask yourself whether the claim could be confidently defended if the CRA requested supporting evidence. Notice that some expense categories may immediately raise questions. For example, a home office claim without supporting calculations, travel expenses without a business itinerary, or miscellaneous expenses without receipts should never be accepted automatically. These items require additional investigation before any tax conclusion can be reached. This careful review process protects both the corporation and the tax preparer. Incorrectly claiming personal or unsupported expenses can lead to reassessments, interest, penalties, and unnecessary discussions with the CRA. The key lesson from this slide is simple but essential. An expense is not deductible simply because it appears on an expense report. It becomes deductible only after it has been properly documented, verified, and shown to have a legitimate business purpose. Once the expense report has been collected and the supporting documents are available, the next step is to analyze each expense category individually. This is an important stage because every type of expense has its own tax rules, documentation requirements, and potential risks. Let's begin with vehicle expenses. Simply claiming fuel, repairs, or insurance does not make these costs deductible. The key question is whether the vehicle was used for business purposes. A mileage log should be maintained to determine the percentage of business use. Only the business portion of vehicle expenses can generally be claimed. Next are meals and entertainment expenses. These require careful review because the Income Tax Act places restrictions on their deductibility. You should verify that the meal had a genuine business purpose. Identify who attended the meeting and ensure that proper receipts are available. In many situations, only 50% of eligible meal expenses are deductible, making accurate classification especially important. Travel expenses also deserve close attention. Airfare, hotels, taxis, and other travel costs may be deductible if they were incurred to earn business income. However, if the trip was partly personal or resembled a vacation, the expenses must be analyzed carefully to separate the business portion from the personal portion. Office supplies are generally easier to evaluate, but they should still be reviewed. Confirm that the purchases were necessary for operating the business and were not personal household items incorrectly charged to the corporation. Home office expenses require a reasonable allocation. If part of the owner's home is used regularly and exclusively for business, a portion of household costs may be deductible. However, the allocation must be reasonable and supported by appropriate calculations. Internet and phone expenses are another common area requiring allocation. Since many owner-managers use the same services for both personal and business purposes, only the business use percentage should generally be claimed. Supporting calculations help justify the amount deducted. Professional fees, such as accounting, legal, or consulting fees, are usually deductible when they relate directly to the business. Nevertheless, it is still important to confirm that the services were provided for business purposes and not for personal matters. Finally, miscellaneous expenses should never be accepted without question. This category often contains items that have been recorded without sufficient detail. Whenever you see miscellaneous expenses, investigate further, request additional documentation, and determine the true nature of each transaction. As you evaluate every expense, follow the same decision-making process. First, verify that supporting documentation exists. Next, confirm there is a genuine business purpose. Then determine whether the amount claimed is reasonable under the circumstances. If all of these conditions are satisfied, the expense can generally be accepted as deductible. If any requirement is not met, the expense should either be questioned or reclassified. The most important lesson from this slide is that different expense categories are governed by different tax rules. A professional accountant understands those differences and applies the appropriate review process to every expense before reaching a tax conclusion. After every individual expense has been reviewed, the final stage is bringing everything together and making the necessary accounting adjustments. This is where the review process is completed and the records are prepared for financial reporting and tax planning. At this point, every expense should have already been evaluated. Some expenses will have met all the requirements for deductibility. They have proper receipts, a legitimate business purpose, reasonable amounts, and sufficient supporting documentation. These expenses remain in the business records as deductible business expenses. Other transactions may not qualify so easily. Personal purchases, unsupported claims, family expenses, or costs that do not relate to earning business income cannot remain as business expenses. Instead, they are removed from the expense accounts and are usually reclassified to the shareholder loan account or treated as shareholder benefits, depending on the circumstances. Not every expense can be decided immediately. Some items simply require additional information from the client. Perhaps a receipt is missing, the business purpose has not been explained, or the available documentation is incomplete. Rather than making assumptions, experienced accountants pause the review, request the necessary information, and wait until they have enough evidence to reach the correct conclusion. Once every expense has been classified, the accounting records are updated. Legitimate business expenses remain in the income statement, while personal expenses are removed and appropriate journal entries are made. If shareholder loan adjustments are required, The shareholder loan account is updated to reflect the amounts that were personally benefited by the owner. These adjustments are critical because they directly affect the corporation's financial statements. Accurate expenses produce accurate net income, and accurate net income forms the basis for reliable corporate tax returns, shareholder tax planning, and compensation decisions later in the engagement. A professional accountant also completes several important administrative tasks before finalizing the file. All supporting documentation should be organized and retained. Every adjustment should be documented in the working papers so another accountant can understand the reasoning behind each decision. Any significant changes should be discussed with the client to ensure they understand why certain expenses were accepted, questioned, or reclassified. This documentation serves another important purpose. If the Canada Revenue Agency ever reviews the file, the working papers provide evidence that every adjustment was made based on proper analysis rather than assumptions or estimates. The final outcome of this review process is a clean and reliable accounting file. The financial statements accurately reflect the corporation's business activities. The shareholder loan account reflects personal transactions correctly, and the tax return can now be prepared using dependable financial information. The key lesson from this slide is that a thorough expense review does far more than identify deductible expenses. It transforms raw bookkeeping records into accurate financial statements, supports sound tax planning, reduces audit risk, and provides the client with financial information they can confidently rely on.